All right, welcome back, everyone. Go ahead and grab a seat, pull out your notebooks. As you all know, finals are looming literally right around the corner, which means it's time for our high-yield final review explainer. I am so pumped to guide you through this today. We're going to take an entire semester's worth of commerce and accounting, the history, the theory, the future applications, and boil it down into one super efficient rapid-fire review. Now, my goal today isn't just to help you scrape by and pass. I want to make sure you actually understand the nuts and bolts of the financial world. We have a ton of ground to cover, and I promise you the stuff we go over today, it's going to be absolutely central to acing that final exam.
Okay, let's dive right into our syllabus for today. We're breaking this explainer down into 4 bite-sized units. First up, accounting evolution. Second, the double entry system. Third, the branches of accounting. And finally, Unit 4, the future. Unit 1, accounting evolution.
Get those pens ready because establishing our historical foundation is totally critical here. You know, accounting is actually one of the oldest practices in human civilization. Way back in ancient India, around 300 BC, Kautilya's Arthashastra was already laying out accounting systems for government finances. Merchants were keeping these meticulous trade records on actual palm leaves. I mean, think about that. Moving ahead to the colonial era, we see the heavy influence of formal British bookkeeping. Then post-independence, the whole thing gets formalized with the Companies Act and the birth of the ICAI, the Institute of Chartered Accountants of India. And finally, we hit the modern era, which is just completely dominated by digital tools, AI, and global standards like IFRS. It's a brilliant illustration of how financial record keeping evolved from literally scratching on palm leaves to running massive standardized global networks. Unit 2, the double entry system. Listen up, folks, because I can practically guarantee this is going to be on your final. The double entry system is, without a doubt, the single most important concept in accounting. By definition, it's a system where every single transaction affects 2 accounts equally. It's actually incredibly simple in practice. Let's look at a classic example. Say your business buys a new laptop for 50,000 rupees in cash. That one single event hits 2 separate places. You debit the laptop account by 50,000 and you credit the cash account by 50,000. Boom, 2 accounts perfectly balanced.
Now, to really master that balance, you absolutely have to memorize these directional flows. Debit, think of it like your inbox, is what comes in. This one's your assets are going up or your expenses are going up. On the flip side, you've got credit. This is the outbox or what goes out. That means your liabilities are increasing or your income is increasing. You've got to burn this inbox/outbox comparison into your brain for the test. Seriously, if you only remember one single thing for the exam, let it be the golden rule. For every debit, there must be an equal and opposite credit. It's basically Newton's third law, but applied to money. Without this fundamental rule, the entire global financial system would literally just collapse. Write it down, highlight it, circle it a million times.
Unit 3, branches of accounting.
All right, so now that we have the mechanical rules down cold, let's compare 2 of the major branches of accounting. First up, cost accounting. The main purpose here is to record and analyze every single cost involved in making a product or providing a service. You're trying to pin down the actual cost of a product and sniff out any wasteful expenses so you can cut them. You'll see this branch used heavily in places like factories, restaurants, and hospitals. Now, contrast that with management accounting. This branch is all about serving up financial data for budgeting, performance reports, and forecasting where the business is heading. And hey, massive hint for your exam right here. Management accounting is strictly for internal use by managers. Unlike financial accounting, which outsiders and investors look at, management accounting stays entirely in-house. That is a classic trick question, so do not let it catch you off guard. Okay, let's pause for a quick pop quiz to see who's still awake. We know how to record transactions, we know how to manage costs, but here's the million-dollar question. How do we actually detect financial fraud and errors hiding in these massive ledgers? Think about it for a second. So the crucial point here is that we don't just blindly trust the numbers. We have to verify them. And we verify them through auditing. Auditing is basically the independent examination of records to make sure they're accurate, honest, and above board. There are 2 main types you need to know for the test. First is the internal audit. As the name suggests, this is done by the company's own internal team to keep an eye on their daily operations. Second is the external or statutory audit. This one is totally independent, performed by an outside chartered accountant, a CA, and it's actually required by law. But despite the different teams, both share the exact same ultimate goal: detecting fraud, catching errors, and ensuring the company is legally compliant.
Unit 4, the future.
As much as exams test your knowledge of the past, your actual careers are going to be defined by the emerging frontiers. So, let's do a rapid-fire review of these modern advancements. First, we have responsibility accounting. This is where each specific department or manager is held strictly accountable for the costs and revenues in their own area. Next up is environmental accounting. Honestly, this is becoming absolutely critical today. It involves tracking the costs of environmental damage and sustainability efforts. Think measuring carbon footprints or pollution control costs. Finally, automated accounting. Guys, the days of massive, dusty paper ledgers are totally gone. Software like Tally, QuickBooks, and Zoho Books now completely automates journal entries, reports, tax filings. It drastically saves time and, most importantly, reduces human error.
Now let's contrast two of the absolute most fascinating new fields out there: blockchain and forensic accounting. Blockchain is all about prevention. It creates this permanent, tamper-proof digital ledger that's shared across tons of computers. Every single transaction is permanently locked in, which eliminates the need for middlemen and vastly reduces the chance of fraud. I mean, it's literally the future of audit trails. On the other hand, we have forensic accounting, which is highly investigative. These are the accountants working alongside law enforcement to dig into financial fraud, money laundering, and tracking down hidden assets or fake invoices from major court cases. So one stops the crime from happening, and the other solves the crime after the fact.
And finally, we simply cannot talk about the future without talking about AI and big data. Artificial intelligence is just totally transforming our field. It can auto-read receipts and invoices using OCR technology, it predicts cash flows, and it even offers real-time anomaly detection to catch fraud the second it happens. It's wild. Combine that with big data, which is the processing of just unbelievably massive volumes of financial data, and banks can now spot instant unusual transactions, predict market trends, and lower compliance risks with incredible speed and scale. Which brings us to the end of our review explainer, and I want to leave you with a final question to really ponder over your studies tonight. As AI and blockchain successfully eliminate human error and completely remove the need for intermediaries, what is the accountant's true role going to be in the future? Are we simply going to become strategic advisors or maybe ethical overseers? Think deeply about that as you review your notes tonight. Best of luck on the final exams, study hard, master those debits and credits, and I will see you all next time.